Hey guys, welcome back to the channel. So we're getting pretty far along in some of these basic videos now, trying to get you guys to understand some of the concepts that go into investing and some of the things behind them and all that good stuff. So we're gonna move it along and move into initial public offering, or what's called an IPO, right? So what is an IPO? An IPO is a process a private company goes through to become a public company. Almost all companies start as privately funded, receiving money from founders, friends, family, stuff like that, right? Once the company has a strategic business plan, it can apply for small business loans and venture capital funding. However, these private funding sources will eventually run out for a growing company. The company then looks for alternative capital to reinvest in its business. So, a common step is to look for public funding by making shares available to public investors through an IPO, right? All right, so what are some advantages? Well, the most important reason for going public is access to funding. Institutional and individual investors can buy public shares of the company's stock to help finance business reinvestment. In return, investors are potentially rewarded with a share of the company's earnings and dividends. Another benefit is alternative funding sources. Part of going public is disclosing a company's financial information, making revenue sources and costs more transparent. This helps a company apply for loans more easily. IPOs are also helpful when one company wants to acquire another. In exchange for purchasing the other business, the company can offer shares of its own stock. In addition, they allow the company to enhance its employee compensation plan. Public companies can offer stock options to employees in addition to a salary, benefiting those who started early in the company's history. Well, how would you spot a bargain IPO? Well, going public also helps the company's brand awareness. It's a very public event, and the company can boost its prestige by listing on a popular exchange, say the NASDAQ or the New York Stock Exchange, right? So, how does an IPO work? Well, the first step in going public is selecting an investment bank to manage the IPO process. These banks include, say JP Morgan, Goldman Sachs, right? Their main objective is to round up buyers interested in purchasing the company's stock. They gauge interest in the IPO and market the stock to institutional investors. They will also assemble a team, including accountants, lawyers, SEC experts, and they're all going to handle different parts of the IPO. Due diligence is the second step in going public. This involves collecting financial documents, completing SEC regulation forms, publicizing the business model, risks, competition. It's also when the company assembles the board of directors, the team responsible for protecting shareholder interest and holding the company leadership accountable. The third step, it involves the SEC approving the IPO. This includes the investment bank and company agreeing to an IPO date, how many shares will be available to the public, and the price for each share. Once the details are settled, the investment bank will distribute financial information to potential investors. Going public is the final step. The company is listed on the exchange and begins trading on the open market. The share price agreed upon by the company and investment bank can now fluctuate based on supply and demand forces. So, what are some disadvantages? Okay, well, fees are the largest concern companies have when going public. Investment bank services are not cheap. I promise you they're not cheap. And the cost to maintain financial, legal, and SEC teams are also not cheap. Not cheap at all. These are just the costs to do an IPO. There are others to maintain a public presence, right? Financial reporting, auditing, and regulation costs will be constant once the company's stock is available to public investors, right? These things are going to happen on such a regular basis, right? It's just over and over, because you've got to, Every year, you have quarterly reportings for companies. So, financial reportings every quarter. You might get audited once a year, twice a year. You might have to pay for certain regulation, paperwork and stuff like that once a year, twice a year, like whatever it's going to be, right? And you got to make, all that stuff when you go public, and also it has to be available to the public investors, right? So anything that happens when it's time to make those reports, you have to give those reports. Usually, it's public, and then it's put on, say, that company's website, and you can go look at it, right? So, SEC regulation is a big concern, and for good reason, right? The SEC's goal is to protect you as the investor, right? So it wants companies to present accurate and complete information. A lot of scrutiny from the SEC, right, won't go away, right? SEC is gonna look at you under a microscope, right? So the companies, they gotta be prepared to meet their guidelines, right? So if a company's gonna go public, the SEC is gonna put them under a microscope and be like, okay, let's see what's been going on. Another issue for company leadership is pressure from shareholders, or you as the investor, and the board of directors. Because these groups now influence the company's direction, they might force leaders to move the business in a way the leaders don't intend. Right? Say you're walking down a path and you want to go right, but the board of directors and shareholders all vote, and now you got to go left. And you as the CEO might go, okay, but going right is the correct choice. I know it's the correct choice. Going left is going to hurt. Well, you went public. It's not really your choice anymore. Going public can be distracting for company leadership, right? Driven to increase stock performance, executives might drift away from their company's mission and engage in unrelated initiatives or questionable corporate behavior, right? So, what do IPOs mean for investors? Well, once a company becomes public, it makes sense to wonder if that stock's going to go, up, down. Is it going to be good for you as an investor? Well, you should probably wait a few months until it stabilizes, right? Each IPO is different, so it might stabilize in a couple weeks, it might stabilize in a couple months, it might stabilize in a year. You just don't know. If the stock's price is less than one of the websites I like to use is Morningstar, and they have what's called a fair value estimate. So if it's less than that, it might be worth considering, right? If it's more than that, you might want to wait a little bit longer, or look at the history of the stock and see how much it goes up or down, right? See the volatility of it. If it's relatively stable, you might be like, okay, it's trading slightly above a fair value estimate, I'm going to buy it anyways. So it really depends on your financial situation, and if how much you believe in that company, right? Because I'm sure there was a time where Tesla or Apple or Google was above Morningstar's fair value estimate, and like, say someone like me, since I use that website for a lot of stuff, I'd be looking at that. I'm like, man, okay, it says it's overpriced. I'm not going to invest in it, but it keeps going up. It keeps going up. It keeps going up. I was like, man, if I would have just, that FOMO, it hits you hard, right? If I would have just, whew. So, really look into the things you need to look into. Research is your best friend when investing, always, right? Research is your best friend. So I really hope you guys enjoyed this. Hopefully you kind of gained some understanding of what an IPO is, right? The initial public offering of a company. And if you guys did enjoy the video, go ahead and give it, a like. If you're not subscribed, go ahead and subscribe. And until I see you guys in the next video, be safe.